From raising capital at Starbucks to flip homes during the 2008 recession, to having nearly $400 million of assets under management and a NASDAQ listing on the books for 2018, my guest today is Chris Loeffler, co-founder and CEO of the Caliber Companies. Welcome to the National Real Estate Forum Podcast, episode 216. Thank you for joining me today. I'm Dr. Adam Gower, and this is the Crowdfund project at nreforum.org, where developers, investors, and industry leaders share insights that you can use to raise capital, build wealth, and earn passive income from crowd-funded real estate deals. In explaining what crowdfunding real estate is, I have found that different explanations resonate with different people. Some folk immediately understand the idea when I tell them that it is a bit like Kickstarter for real estate, only different. For others, explaining that it is a new way to syndicate a real estate deal is enough. Others find it more intuitive to talk in terms of it being like joining the local country club but without the dues, and gaining access to the deals traditionally held exclusively by that kind of network. Well, I recently stumbled across another example that might mean something to you. I found a clause in an operating agreement that I'm using as a case study in the course I am shortly to be launching, 8 Keys to Understanding Every Crowdfund Real Estate Deal. In the agreement, the investor has to state that he or she has, quote, not seen, received, been presented with, or been solicited by any advertisement or any general solicitation with respect to the investment in any form, unquote. Well, that says it all. That kind of clause is gone completely, because now you can advertise on the internet to the whole world, and it is directly through advertising that everyone now learns about and invests in real estate deals. Up until recently, a developer was prohibited from advertising, and now they can advertise anywhere. And investors who previously had no access to these deals can now pick and choose from a huge range of options and select that which is most suitable for them. As I've been building the 8 Keys to Crowdfunding Real Estate course, I've been putting together a glossary of real estate crowdfunding terms that I hope is written in plain English, and I'd love your feedback. Download a copy absolutely free at the show notes page for today's episode at the nationalrealestateforum.org website at nreforum.org/caliber, and let me know if I've been successful in explaining the concepts clearly. I'd love to hear your thoughts. Last year, I started teaching courses on real estate investment and finance on faculty at the renowned Ophelia Business School at Cal Poly of the Caliber Companies, and my guest today, Chris Loeffler, showed up and took over all my classes for the entire day. I heard Chris's story 3 times that day, once for each class he taught, and it was as compelling and inspirational when I heard it again as we recorded this podcast. Be sure to check out the show notes to today's episode at nreforum.org/caliber for links to the company website, its IPO page, and a transcript to today's episode. I hope you enjoy hearing from Chris as much as I enjoy talking to him. First of all, even though I've heard it before, for my listeners, both of them, I wonder if perhaps you could tell me a bit about your background and how you come to where you are now.
Sure. So, for all of your listeners, which I'm sure there are many thousands, if not many millions at some point in time, I think I've gotten to where I've gotten to
where you are now.
Sure. So, for all of your listeners, which I'm sure there are many thousands, if not many millions at some point in time, I think I've gotten to where I've gotten to through a combination of maybe some smart luck and some dumb luck combined. But
okay.
When I left Cal Poly, I started my career at PricewaterhouseCoopers, and I was doing accounting, going down the corporate path, and an opportunity came to me to start buying and selling auction properties at trustee sale auctions and basically flipping homes. And I partnered with 2 experienced real estate entrepreneurs, and we started with a small company that was literally running an auction business where we went to the auctions on a daily basis, and We bid on properties every day. We would drive them in the mornings from 4 or 5 o'clock in the morning until 10 o'clock properties, and looking at them and inspecting them and making sure that they weren't, gutted or it didn't have cracks in the foundation, things like that. And then we would bid at auctions all day long. And then if we won a bid, we would go check out the properties. And we had a small remodeling company. We would do all of our own remodeling in-house and would renovate the properties. And then we listed them for sale via our retail brokerage, and would sell them back to homeowners once they were fixed up and such. So that was our business, starting from scratch.
Right. And how were you financed at that time, Chris?
At the time, we were financed literally by anybody who would listen to us. And
right.
we didn't have any family money or any startup capital or formal venture funding or anything like that. We literally would meet people through the random circumstance of life and tell them what we were doing and ask them if they wanted to flip a home and tell them how it worked.
Starbucks one time.
One time we had a deal we had bought, and the way the trustee sales work is you put a $10,000 check down as a deposit the day you win the auction, and the next day, 24 hours later, you have to pay for it in full in cash. And we had bought 2 or 3 homes, or I think it was 3 homes, and we only had enough money to fund 2. So we had $10,000 on the line, and literally from meeting somebody at a Starbucks at 4 o'clock in the afternoon, the next day we had a new investor who wrote a $50,000 check that helped us close on the third home. So it was not a recommended way to build a business if you can get a better access to capital, but in 2009 that was about the best we could do.
Okay, so tell me what you've discovered since then by way of access to capital.
Yeah, so since then, fast forward 9 years later, and Caliber has built a sophisticated, essentially real estate private equity company where we're consistently raising capital into funds that have been structured to meet the investors' needs. The funds are built with their needs in mind, so that they can invest for long term for growth, for the short term for fixed income, or for the midterm for a little bit of combination of both. The funds operate independently of the deal, so we're always raising capital in the funds because we know that we can deploy it eventually. And as we raise capital in the funds, on the flip side, we're also a company doing real estate deals across the board. So we're doing hotels, apartments, office buildings, commercial properties, self-storage facilities, single-family homes, sort of you name it, and all across what I would call the middle market. And essentially, the company has built itself up to about $300 million in assets under management. We've learned how the sophisticated ways to raise capital from accredited high net worth investors and their wealth advisors.
Okay, so let's unwrap that a little bit. What has enabled you to do this is the Jobs Act, isn't it?
Yeah.
What are the mechanisms of the Jobs Act that you're utilizing?
So the Jobs Act, for those who aren't familiar, was a piece of legislation that passed in 2013 that made legal for the first time since the Great Depression the ability to what they call publicly solicit for private equity capital. And what that means is if you're using a Reg D 506B or now 506C private offering, you can, instead of having to know or have an existing business relationship with the investors that you're trying to solicit into your funds, you could actually advertise. You could put up a website. You could build a marketing strategy around meeting potentially accredited investors, soliciting them to fund. So that is, if you can imagine what it's like to build a business when you can't tell anybody that you're in the business and you can't market or promote it, it's a little challenging.
So what you're doing is you're doing just 506C offerings, right? You're only accredited investors.
That's how we.
Number
that's
one.
Sort of how we started. We're now doing some more sophisticated elements of the Jobs Act as well.
Okay.
The second element of the Jobs Act was an expansion of another capital raising tool called Reg A+. It used to be called Regulation A or Reg A. Now it's Reg
so
A+.
You've got to tell me about that because I mentioned it to a friend of mine yesterday, and he asked if it had something to do with the Caribbean. It took me a while to put the Reg A.
No,
I didn't know what he was talking about. Yeah, it took me a while. I wasn't sure why he'd gone there, but
The first time we did an event, we had investors scratching their head. Why does he keep saying reggae?
Reggae? What's he talking about? Okay, so reg.A or space A plus.
Yes.
What are you doing in reggae plus? How are you going from 506C to reggae plus? What I'm seeing is different with you is that I've been talking to a lot of crowdfunding sites. Right, who are basically tech marketplaces, and they're utilizing these regulations to create marketplaces. But you're doing something a bit different, aren't you? Explain what you're doing.
Yeah, so at the end of the day, the crowdfunding websites, they're a platform, right? But they need what you would refer to and what we refer to as an issuer, which is us, the issuer of the private securities, to come on the platform, put together a deal, formulate a security, issue it through the platform, and basically make sure they have inventory so that investors can raise money through which regulatory option, whether it's a Reg D or Reg A plus or Regulation CF crowdfunding option or state-based crowdfunding, all the different options you have in state-based crowdfunding. Those different choices that I make as an issuer on how I'm going to raise the money, make a decision on who can invest, how it can be solicited, and essentially where I can get my capital from and what those investors can actually access. So the best thing about Reg A, bottom line, is that in a regulation CF, like a crowdfunding deal or local crowdfunding and like interstate crowdfunding in your state, you're pretty much limited to raising like $2.5 million, which, is not enough money to do a lot of different things. In a Reg A plus deal, you can raise up to $50 million per year. And so it really gives you a much wider amount of capital $50 million per year. And so it really gives you a much wider amount of capital that you can raise. And unlike Reg D, you're not restricted to accredited investors only. So if you have the right technology platform to be able to process the investments and manage the relationships with the investors, then there's no difference to you between 100 investors at $100 or 1,000 investors at $10. And then when you look at the big numbers that we're talking about, if your minimum check size is $100,000 from an accredited investor and your minimum check size from a non-accredited investor might be $5,000, if you can get the same amount of total capital from both parties, the non-accredited investors are typically going to be a little easier to work with and maybe might give you a better deal because they have a lower level of expectation for return on a $5,000 investment.
That's interesting. Now, the fundamental difference is that you are actually the sponsor, aren't you? You're going out and buying these deals and you're adding value and developing them or whatever it is. You're not an intermediary. You're not a platform. You are the actual developer who is using, in the first case, 506C to raise capital, but now moving to the Reg A plus.
Yeah, so we're doing both different types of offerings, and I'll actually tell you how they interact or intercombine.
Okay.
But on the developer side, we are a vertically integrated platform. So just like you said, not only do we raise the capital and act as what you would normally refer to as an asset manager, which is just raising capital and allocating the capital and then managing the managers essentially. We are also out there actively being the real estate manager, actively being the developer, actively buying the deals and doing the deal making and the structuring, the finance and the construction and the maintenance, and you name it. So we're in it. We're very, very close to the deals, and that sometimes that gives us a competitive advantage in the marketplace. As far as Reg A and Reg D, the Reg D deals, we have a $100 million commercial asset fund that, is a bigger fund than we could do under Reg A. But the interesting thing that's come out now is some of our competitors are doing this. We haven't done this yet because the Reg A that we're doing now is for our parent company. But some of our competitors have started to create like a child fund. So they might have a $100 million or $200 million or $500 million or $1 billion fund, and they'll create a little mini new company. They'll get it audited. They'll go through the Reg A requirements, which are not that difficult, and they'll raise $50 million into that offering. And that offering, that fund, that company, the only purpose of that company is to buy a piece of your larger accredited investor fund. So in essence, for the non-accredited investor for the first time ever, that gives them a legal way to invest just like an accredited investor would. And they might pay a small spread in fees or something like that versus what the non-accredited or the accredited investor spends. But at the end of the day, what's the point? The point is individual investors are not getting access to these types of wealth building tools if they're not accredited, and this is a way for them to get access.
So when you do your Reg A plus offering and somebody invests in that, are they investing in individual deals as they would be in a Reg D, or are they buying shares in an entity that as a whole has to perform with a portfolio of assets under its umbrella?
It really depends. So just like a Reg D, you might be buying membership interest or a limited partnership interest. At the end of the day, you're buying roughly, translates to shares, right, in a company. If that company is only acquiring one, if that company is going to buy 20 deals in a portfolio, then you're buying shares in a portfolio. The Reg A works the same way. If you issue a Reg A to raise capital for one deal, then it's a single deal Reg A type company. And if you end up doing it to invest into a fund or into a portfolio, same deal. You're investing into a portfolio of assets, but you own the company owns the assets.
And in your case, when you do your Reg A plus offering, what are you doing? You're exiting certain, or you're going to contribute certain deals that you already have in order to exit somehow?
Ours is actually pretty interesting. We're using this because once you do a Reg A offering, you are effectively becoming a public company. So public reporting, non-trading. And what that means is you have to file a 10K at the end of the year, and you have to file a mid-year report. You don't have to report 4 times a year. You report twice a year. The reporting requirements give the company a lot more transparency into the business instead of investing into a private company. So that's sort of the trade-off. But, the cost to maintain that reporting, if you're never going to trade the stock on a senior exchange and you're not going to be subject to like NASDAQ reporting requirements and things like that, it can still be managed.
Negligible, right?
Yeah.
Right.
So that's one thing. If you're going to be running $50 million of other people's money, trust me, you're going to be doing the same types of external audits and hardcore financial reporting that you need to do anyway if you were a private company. There's really not too much difference in my mind if you're running the business the right way. What we're using this for is a bridge to take our overall company, what we call our parent company, and that's the business that acts as the general partner and has our equity and our interest in all of our assets. So it's all the assets that we own and all the control positions we have in all of our funds, as well as owns our operating companies, which is our in-house issuer-dealer. It has our real estate company, our brokerage, our property management company, our construction, our development. All of those businesses all roll up into a single entity. That entity is doing a Reg A plus offering to raise up to $50 million to become a public reporting but non-trading company. So for the first time ever, non-accredited investors could own a piece of what we do. And then the second phase of that for us at the end of 2018 is that we plan to actually list the stock on the NASDAQ and become a NASDAQ-traded public company. So you don't have to do that, but you do have the ability to do that if you later decide to do so.
Okay.
Having said that, what we also are going to do at some point in time is create these new, fresh companies that are, there's nothing in them. Get them audited, do a Reg A offering on that company, and that company will be basically a child, and that company will be basically a child fund to each of our main Reg D funds. So the investors in our public offering, as we refer to it for the parent company, are buying into the operating company and all of our assets and all of our deals. The people who invest in the Reg A that's associated with our funds are effectively just investing in that fund.
So through the first Reg A offering that you're going to do, basically investors are going to be investing in a development company, a real estate development company, and we'll have shares in that, and that company will have different divisions underneath it, brokerage and management, etc. All right, so let's switch, if you don't mind, let's switch to what kind of deals you look at, right? Because everything sits on top of a foundation of the kind of deals and the caliber of deals, if you'll forgive the pun, that you look at. So you've mentioned, it is a good one, right? So you've already described several asset classes. So tell me what's your general investment strategy globally across the company? What kind of deals are you looking for? What kind of returns? What kind of risk profile? I know you don't like California, no matter how much I beg you to come here. So you've obviously got some strong ideas about where you like to invest and what.
I love California. I love to visit. I love to enjoy the restaurants. I love the people. All of that. I'm not quite sure we want to expose ourselves to doing business in California.
All right. Don't forget to pick up your free plain English glossary of crowdfund real estate terms by going to the show notes page for today's episode at the National Real Estate Forum.org website, nreforum.org/caliber, and let me know what you think. All right, so what are you exposing yourself to? Tell me.
Well, yeah, so the greatest thing about our industry is that it has so few real conferences and infrastructure so that the industry can get together and talk to each other, that as an entrepreneur we get to just make it up as we go along. So we call it, I refer to the types of deals we go after as middle market deals, which is assets that are typically too big or too complex for, a handful of doctors to get together, open an LLC and buy a property. So we're not doing like $2 million deals or $500,000 deals or $3 million deals or some deals that are small enough that a couple of people can get together, open an LLC and buy the asset. Or even if they all are smaller deals, the complexity level is just too immense for any individual investors that are not full-time investors to be able to handle. And those smaller deals usually lead to bigger deals. So we might they're all like little $1 million buildings, but we intend to buy real estate all around them as we transform the downtown. We plan to transform and grow the value nearby. And then on the larger side, we buy assets that are smaller than typically around $40 or $50 million in check size to do the entire deal, which are usually properties that are too small for an institution like a REIT, a public REIT, to buy, or, an insurance company or something like that. Or they're in markets like Flagstaff and Tucson and Henderson and Salt Lake City and others that are not the major markets that those large pension funds, insurance companies, REITs, et cetera, typically buy their assets in. So we don't want to compete with people who have money that costs almost nothing for them to deploy, and we don't want to compete at too low of a scale with small sins. So we don't want to compete with people who have money that costs almost nothing for them to deploy, and we don't want to compete at too low of a scale with smaller investors who are just, really scrappy and can afford the time to be able to work the deals at that level.
And what kind of asset classes do you like? Are there any you don't like?
A good deal is a good deal almost no matter what it is. I don't like asset classes that are hyped up, but that changes over time. So there's a lot of hype around assisted living and that kind of stuff. There's a lot of hype around student housing. There's a lot of hype around apartments in general. And having said that, we're doing student housing projects, and we just looked at an assisted living project. So even though we don't necessarily exclude anything, I just know that, anytime a lot of people are talking about the fact that the really good idea to do a specific kind of deal, it's usually too late. It's time to move on.
And what kind of returns do you look for? How do you decide to do a deal from a risk-return basis? What are your return targets?
We have an underwriting model that I think is elegant and simple. In essence, we want to buy an asset that in a position where on acquisition we're getting a better than 20% discount to market. So we want to buy properties for less than what we believe they are inherently worth. The second thing that we want to do is we want to essentially fully transform the asset and exit at a 10 cap. What that means is if we bought the asset for $500,000, we put $500,000 in renovation into it, the asset, by the time we're done with that transformation, might take us 12 months, it might take us 24 months. Going forward, we'll make at least $100,000 a year in profit, which is a 10% cap rate. Every deal has a story. Every deal has the ability to transform the property in some way, shape, or form if it's a real deal. And it's just, can you execute on the plan?
So how are you sourcing deals? Because those are pretty ambitious targets in this market. And if you're finding deal flow like that, you're doing very well. So without, sharing your deepest secrets, how are you sourcing deals?
Step number one, you got to leave California.
Yes. Okay. So point taken. Right.
No, but seriously, it's relationships. This business is and always will be relationships. It's brokers that get the inside track that want to do business with people they know will just pay them a fee and take care of them. It's notoriety. People know caliber in the Arizona market and the markets that we're in. And so they know that, information just comes to us. I don't active work to find deals, and we definitely go work the deals and work the relationships. But at the end of the day, it's who you know and how out there you are and how clear you are in your intentions of what you're looking for, and stuff tends to come. And then it's the imagination to be able to take a deal that everybody else sees a 6-cap deal on, and you can see the 10-cap deal by making the tweaks that they didn't see. So it's applying all that real estate imagination and deal-making ability that hopefully you build over time over your career. And I'm certainly still building. I've got a long way to go.
Chris, how many people do you have employed at the moment that will end up under the Reg A company?
Actually, technically, we have over 700, but that includes basically all the employees at our assets, and considering the fact that we own 7 hotels, that's where that comes from. We manage this entire company with a core team of about 50 employees.
Okay, and you're in Phoenix, right?
Yeah, we're in Scottsdale. We manage this entire company with a core team of about 50 employees. Okay, and you're in Phoenix, right? Yeah, we're in Scottsdale. So tell me, what are the biggest challenges that you face as you move towards this Reg A offering? As a founder of a real estate business, the culture of our industry is, there's a lot of real estate entrepreneurs that are pursuing lifestyle businesses. If you get good at this and you know what you're doing, with you and a partner or you by yourself and an assistant in a very small shop, you can make a really nice income for yourself. And as you build a reputation over years and years, with about 20 or 30 investors, which is pretty easy to manage, you can build into a multi-million-dollar business. It's not as easy as I'm making it sound, but it's not as difficult once you understand what you're doing. The problem is if you want to build a real company, like a real business and a real enterprise that's going to be something beyond something your needs and your lifestyle, it's the path to go and do that is very difficult. There are no banks that view you, especially as a small real estate investment company, as a lendable entity. So they might lend you money on your real estate assets, but they won't lend you the money to build your business. As you build your business, you're going to make bad hires. You're going to pick the wrong software. You're going to waste money on a strategy that doesn't work. And you have a really fixed income in these deals where you might get some fees up front and you might get some fees along the way. But most of your money comes from the profit, and you might not see that profit for 3 to 5 years. And so you're still having to pay salary that whole time. So we've found, as we've grown our business, every year for 9 years, my partners and I have had to look at each other and say, do we want to make money personally, or do we want to build this company? Because those are two somewhat mutually exclusive things. And as we go into the public offering and the public company, we'll be able to get beyond the main hurdles that stop a company like ours from being able to function the same way as, if we manufactured toasters, we would be much more supported in the community in terms of lending relationships and equity capital and things like that. But our type of business, our class of business, there's really no clearly defined path for growth. And there's a lot of regulatory risk and a lot of execution risk that goes along the way. So I would encourage anybody listening, if you want to build a business like this, to consider why. Are you building it for your lifestyle?
Exactly.
Right. Or do you really want to build this type of company because the sacrifices you have to make and the risks that you have to take are pretty wide. Once we're public, the world changes. We become a great lendable company. Everybody wants to give us money. The world is sort of a different world. But that's a 10-year process and a lot of risk along the way.
So what about the risk of the Reg A offering itself? How confident are you that you're going to be able to raise the $50 million that you're looking for, and what happens if you fall short?
Well, for us, our target is relatively small because if we raise $5 million or if we raise $15 million, the offering was a success for us.
Okay.
So one answer to your question is because in 9 years we've raised over $200 million in equity capital from individual investors, I know that I can raise 5 to 15. If I was starting a business and this was my first capital raise, there's a high likelihood that I could fail because I don't know how to market for capital. I don't know how to properly talk to investors. I don't know how to pitch. I don't know how to present. There's all kinds of things that I wouldn't know. And for those people that are looking in that direction, there's really, in the normal public process, there's a whole infrastructure of investment banks set up that can help you get known. In the Reg A land, in the Reg A world, nobody should be doing a Reg A offering if they don't know how to raise capital within the company because there's not that infrastructure yet. It's being built as we speak every day. It's getting better. There are some banks that are specializing in this that can help, but it's not where it needs to be for you to be able to successfully raise capital if you don't know what you're doing.
How can banks help with a Reg A offering?
Traditional banks, not much. There's not much that they can do.
Right.
The investment banks that are out there, I'll try to avoid too much of a lecture on regulation, but at the end of the day, whether we like it or not, one thing is true, and that is that a tremendous amount of independent broker-dealers have been put out of business by regulation over the last 10 years. And what that means is because, let me give you a scenario. I was at a conference, and a gentleman was telling his story. He'd been in the independent broker-dealer investment banking space, as many people would call it, for 30 years. Expert guy, really knew what he was doing. And in 2009 or 2007 or something like that, he had an investor come to him and say, I want to invest in oil and gas or something like that. And so he offered the investor a direct investment through a private placement, very similar to what we do in real estate, private equity, where that investor could own a portion of the company, and the company would be drilling for oil, and if they were successful, he'd make a lot of money, and if they weren't, then that's the way it works, right? Mm-hmm. Well, this investor, the regulators say that because that's an illiquid investment, that almost always that's an inappropriate investment for the client. So the broker also showed him a public company that was a liquid option, and to do the same thing where the investor could have sold the share, but showed the investor for many reasons why investing privately was going to get him a better deal. He was getting a better price. It was better. It was safer for his capital, all that kind of stuff. Fast forward 6-7 years later, this guy who's been in the business for 30 years is under investigation by the SEC. He's got FINRA coming to him and, telling him he did everything wrong. The investor's suing him because he lost money on the deal. Well, he went through 2008,
Right, exactly.
A lot of people lost money. And at the end of the day, FINRA basically said to this broker-dealer that it would have been better because the BD actually was able to show that had he put the client into the liquid investment that he wanted to invest into, he would have lost 80 to 90% of his money instead of 50% of his money. FINRA said that it would have been a better choice for that BD to make him choose the liquid investment and lose more of his money. In that case, he would have not have gotten any fines or any action and lose more of his money. In that case, he would have not have gotten any fines or any action against him. But because he chose the illiquid investment, he got fined by FINRA and the SEC, and he had action against him. So in a regulatory environment like that, with that kind of a specific example, unfortunately, a lot of companies have gone out of business. And when those companies go out of business, nobody's buying, nobody's selling, and there's no marketplace. So the short answer is the only way that we can do anything about it is, roll back the regulation to something that's more reasonable, allow the broker-dealers to come back into business and start doing business and raising capital, and that will build a capital market.
Is there no secondary market for your shares? There was a guy I spoke to the other day. He has set up a marketplace for otherwise untradeable products, right? But that you can trade. I mean, if I buy shares in your offering, I can trade them as if you allow me to, right? If you allow me to, right?
Correct. Yeah, how that works they're unrestricted. So yes, there are some. As of a year ago, there were none. As of the end of this year, I think that there will be some good options, and as of a year from now, I think there are going to be some incredible options for these types of shares. And so I think that it's just an evolution of a brand new marketplace that's never existed before.
Right.
And we'll see what comes of it.
Let me ask you a couple of final wrapping up questions. The first one is, since the Jobs Act, and you're really riding this new act incredibly efficiently, where do you think it's going to go? How do you think it's going to change the real estate industry?
I think that the real estate industry has been due for change for a long time. And what I mean by that is that if you look around at our neighborhoods and our communities, there's a reasons why you see so many Walgreens and why you see so many strip malls that look relatively the same. They're always packed, and that's where all the cars are. The answer to that, in my mind, is that everything in real estate at a large scale has been driven by the public capital markets and institutional capital investing into deals. And what is institutional capital like? They do the same deal the same way, the same time, 1,000 times across the country, so we can put $2 billion into this strategy. And that way, it's efficient for everybody. But what is real estate? Real estate it's local. It's hyper-local. It's, one thing on one corner in one street is different from a different corner, 1,000 feet away. And so what people really want is they really want the local coffee shops. They really want the local shopping experience. They really want that kind of experience in an office space, in retail, et cetera. And because of that, these funding mechanisms are the thing that will bridge the gap, I think. People are going to start investing in their own communities because, 60 to 70% of our investors at Caliber are Arizona residents, and they love, investing in projects that they can drive by and see that they own a piece of that hotel or the self-storage facility. And in addition to that, developers are going to be able to say, you know what, I want to build this really quirky, weird, mixed-use type deal here on this corner. I'm going to put a sign up on my property and offer it out to the community to support my project by voting with their dollars. And so all of those things, I think, are changing the real estate business because that capital is cheaper than the normal sources of capital, and it's allowing me to build a project that's frankly more profitable.
Now, are you you're still looking to solicit new investors?
Oh yeah, all the time, always.
And are you finding that people you're still looking to solicit new investors?
Oh yeah, all the time, always.
And are you finding that people are investing, as you described, locally? So if you have a local deal, that you're finding more people inclined in the vicinity to invest, or are you finding people are investing across the platform?
That was our trend for years. And as Caliber started to mature, that they were investing more locally, we've built an investment experience that allows people, from across the country or from other countries to be able to make an investment and know that they don't necessarily have to know the market to feel comfortable with the investment. And so I think as our business has matured and our platform has matured and what we offer to clients has matured, we're actually expanding that so that ratio is starting to come down. But still, and I think it is and always will be, if we do it, we just did a deal that the clients that are in that state are going to say, well, how do I get involved in this Denver deal? Because that's what they like, and that's what people enjoy.
Do you do entitlements?
Yeah.
Yeah, so do you find it useful to have local investors when it comes to entitlements in front of the planning committee or the local council to get it through, that you have somebody, a neighbor standing up and advocating for a project?
I think it's incredibly useful to have local investors for everything, for finding additional investors, for exactly what you said, neighborhood meeting. You've got somebody who owns another business that's well respected saying, I support the project. People in my business, in the investment business, generally, especially people in my role, avoid talking to their investors pretty much at all costs. And when they do, they have very structured communications so that they don't have to be in a situation where they said or did something wrong. My philosophy is the only thing that gets us in trouble with our investors is not having a relationship with them. So if something goes wrong and I can't lean on the fact that, hey, they know we're trustworthy people and we're just working through a problem because real estate problems occur, then, that's the big issue. So I love all of our investors. They're great people. All of them are typically leaders in the community, business owners, doctors, lawyers, you name it, and they all have connectivity to things that we need. And some of our projects actually come from our investors because they see something from some element of their network and they kick it over to us. So I think if you're in the real estate investment business and you think that the most important thing in the business is the deal, I think you've lost sight of what really matters. It's the relationships, it's the investors, it's making them happy. If you have good quality equity investors and good relationships, I guarantee you the deals will almost always be there.
Very nice, Chris. When is your Reg A offering scheduled to go public?
We're doing a Test the Waters campaign, so allows us to actually talk about it, which is another great thing about Reg A. So people can go to www.caliberipo.com and they can actually, enter their information, and we'll start following up with them as the offering starts to come to fruition. Our goal is to file the offering towards the end of this year and have it effective and active for the first part of next year, which means that we're public reporting. And then from there, we're going to take sort of the first and second half of 2018 to make sure that our infrastructure is working good, our financial reporting structure is working well, and then we plan to list on the NASDAQ in the second half of 2018.
So you're doing a tier 2, are you?
Tier 2, yeah. So it's tier 2 requires audited financials and such.
Right. Chris, thank you so very much for your time today. I know how insanely busy you are. Are you going to come and visit us again and spend a day teaching the students as you did so eloquently last time?
For me, that was probably one of the best days I've had, in years. So, yeah, if I can get back out, I will absolutely come back out. And to the extent that a bunch of students actually want to listen to me, I will always be happy to share what knowledge I have.
Well, they were absolutely thrilled. And I know I still, to this day, people still ask me, now that guy that came in to talk to us, can you remember his name? Give me his email address. And so every now and then, I know you probably get a call from one of them. You can count.
Oh, I have. I've scheduled calls with a handful of the students, and to the extent we build a better industry out here, I would, I'm happy to make a contribution to it.
Caliber is one of the few real estate companies that is using Jobs Act regulations to go public. To do, as I discussed in podcast 203 with Rod Turner, a mini IPO in which you can actually buy shares in a real estate development company. This now gives individuals the opportunity to invest in developments directly in their own communities, and as a consequence, communities around the country are going to grow more in a way that people actually want, rather than how corporate America wants them to grow, because it works well on a spreadsheet on someone's desk in an ivory tower somewhere else. If you would like to learn more about Chris Loeffler's upcoming IPO or his business in general, please go to the show notes to this episode at the nationalrealestateforum.org website, nreforum.org/caliber, put together of crowdfund real estate terms that you can use to better understand some of the jargon used in the space. If there are any terms I explained that remain hard to understand, or if there are any missing that you would like me to cover, please contact me at the contact page at the nreforum.org website. I'd love to hear from you. The next podcast will be with Nick Walsh, founder and principal at Global Senior Housing. Nick is a recent entrant into the exciting and highly specialized world of senior housing and used crowdfunding to raise capital for his first deal in the space. His story is especially fascinating if you're interested in any aspect of senior housing investing, and you can catch it on just about any platform where you listen to podcasts. Thanks for tuning in, and thank you also to Chris Loeffler, founder and CEO of Caliber Companies, for sharing your time with me today. Until next time, this is Dr. Adam Gower, signing off.